Hey guys, Tim Kotzman here with Ben Werkman. Ben, how are you?
I'm doing very well, Tim. I'm ready to have this conversation. Thank you for inviting me on.
Thanks for making the time. Do you want to start with some of your background and your journey to Bitcoin?
Absolutely, yeah. So my background as far as Bitcoiners go has been a little non-traditional. I actually started coming right out of college in '09. I started in commercial banking. And during that time, as you can imagine, there was a ton of non-performing loans that were out there. And so I joined in as a credit analyst at a community bank here in Michigan, where we were essentially in charge of, working out the bad loans, right? Trying to keep them afloat, giving them more rope if they were going to be able to make payments, right? Finding ways to, minimize our risk where we could. So I started in a very risk-off environment. And that was kind of my initial entrance into the world of finance. And then when I left that, after we kind of got through that period and the excitement was kind of dying down in the banking world, things had stabilized, I went a completely different path. And I actually turned off and went into the consulting world. So I started in the consulting world doing a lot of governance work for a lot of the Fortune 500 companies. And that was essentially focused around IT outsourcing. So application development contracts, infrastructure contracts, things of that nature. And then I did a brief stint off at a tech startup that was doing legal tech, kind of AI for legal contracting, all those sorts of things. And then I decided I was going to venture out onto my own a little bit. And so around COVID, when everyone started getting locked inside and we had a lot of time on our hands, I spent some time, learning how to code, focusing on how could I automate some of my own trading. And then I actually ventured out to build my own platform to do automated trading for retail customers. So that'll be launching here soon, but that's kind of the path that I've gone down from a career perspective. When I look back at Bitcoin, I was actually pretty early to finding Bitcoin. I'm not going to say that I capitalized on that early finding as well as I might have hoped today that I had, but my first finding of Bitcoin was really back in 2012. And, I could really, I'd started talking about it. I saw it, I think, at the Wall Street Journal. There was actually an article that was out there
Hmm.
on it, talking about what is this thing? And so I brought it to my dad. He's worked in finance forever as a financial advisor. And so I asked him, like, have you ever heard about this? And so we were talking about it and we were jokingly saying, we should buy 1,000 of them and see what happens. I mean, they're only $200 right now. So, but he couldn't do that because of regulations and all that. So it was a fun daydream, but that was the first time I saw it. And then it kind of faded away for a little bit, right? You didn't really hear about it. You heard about it on that first run up when it went from, being worth pennies to being worth hundreds of dollars. But then it kind of quieted down. And I wouldn't say I really came back around to it until maybe 2017 was when I started really getting back into the fold of it. And that was when a lot of the excitement was coming back into the cycles. And, I'm man enough to admit that I may have deterred a little bit and went down the other cryptocurrency paths for a while. And I think a lot of people do. I think it's kind of an important part of the journey to learn what it is that you're dealing with and which ones of these do you really find have value in the digital asset landscape and which ones don't you. And you pretty quickly through that journey, you narrow in fast. And it didn't take long until I really realized that Bitcoin was going to be the one that I could see being the future, right? This was the one with all the characteristics that you want in a financial asset, right? A digital asset in digital form. And so I quickly started changing my focus to just Bitcoin, right? I didn't need to play
Hmm.
around with any of the other stuff anymore. I started watching some of the early adopters that were out here on Twitter and learning about it. And it didn't take long before I was kind of hooked, right? And I have this thing where once I get hooked on something, I want to go deep and I want to figure out how they're created. I want to figure out all the problems they're supposed to be solving with money and really make sure that in my mind, I can articulate the value proposition for it to convince myself that it's an asset that I should be in. And through that journey, that kind of brought me to, okay, I think this is a good asset that I want to own personally, right? This should be a part of my portfolio. But then I started expanding into kind of the corporate world and going, well, how's this asset going to really get into the mix with traditional corporations? How are they going to view this? And as we all know, kind of the first guy that came out of the gate here, who was a naysayer early on, was Michael Saylor. And he took that real bold move as a public company in the United States saying, I believe in this thing now. I was wrong, right? I've done the research. I've spent my 10,000 hours, and this is something that corporations should own. And the conviction that he went in with, even early, when he was essentially completely shifting strategies for his own company that he founded, which is tough to do, right? I mean, getting
Mm-hmm.
married to what your company does is one of those things that I think a lot of us fall victim to, where you don't want to change because you so badly want what you did first to work that you're not willing to pivot. And to his credit, he saw something different. He saw what he had working, but not growing anymore, right? It built him a very strong company. It put him through the ringer, right? I mean, he was one of those dot-com bubble bursts. It was a really ugly time for him, I'm sure. I'm sure there wasn't a lot of sleep during that period. But he was smart enough to really look at this and go, maybe there's a way we can reinvent ourselves. And we can look at a different way to utilize the strength of our business that's outside of what we're doing today as our core business, right? The business intelligence side of things. And so that pivot was really, it was tough to digest at first when you hear about it. You know, you start with the small, like, okay, we have cash, we're going to put the cash into Bitcoin. No problem, because we generate positive free cash flow. So we have more cash coming in to cover our operations. You know, not really a big gamble there. But when you saw him start to change that strategy and go, maybe we'll go borrow money and we'll buy Bitcoin, right? That's when things started getting really interesting. And you kind of pause and you go, well, wait a second, this is something we've not seen done in corporate America yet, right? Particularly on this scale. And so it starts to draw in your attention. And pretty soon it's really tough to pay attention to anything else because a lot of the other storylines kind of lose their excitement for you, right? They lose their focus because you've seen it before. It's not a new play, right? But it is when you're changing the strategy of your corporation to leverage an emerging asset class, right? That is risky when you look at it, particularly in the early days. It looks less so now because we've had some of these adoptions coming from players like BlackRock and Fidelity and now BNY Mellon and some of these big, you know, blue chip style companies that are out there that everybody knows and everybody trusts, right? These asset managers for trillions of dollars are bringing legitimacy to the strategy. But when he started it, he didn't know that, right? We didn't know that that was going to come. We'd all hoped, right? Everyone hopes that the big guys adopt their thing, right? I mean,
Mm-hmm.
that's always a part of your personal roadmap, but he didn't know it when he embarked on that strategy. And so ever since then, it's kind of hooked me in. And I've gone, this is something I really do want to follow, right? I want to see where this goes. I want to see how he's going to implement this strategy. And what's been really interesting along the way is that it's pivoted and evolved in ways that I don't think we necessarily understood early on. So that hooked me in. That's where a lot of the things that I'm now posting out there on X that people have started to engage with, which actually brought us together to have this conversation. You know, it brought me into a really interesting group of people that are thinking differently. And I really value that because I always want to challenge my own way of thinking about a topic, particularly if it's an area that I'm investing capital in, right? When you look at something you're investing capital in, the best thing that you can do is search for ways that you're wrong, right? Because you always want to be right. The best thing you can do is to prove that you're wrong on one of these investments because it allows you that moment to pivot in ways that other people might not. And so I've spent a couple years now trying to find the way that I'm wrong here and the way that Saylor's wrong here. And because I haven't been able to do that yet, it's just led me further and further down this path. So it's been a really exciting journey. And it's been a very fun intellectual journey because it forces you to think about the future where some of these digital assets might really come to the forefront of how we interact as society, how businesses are going to operate, how insurance companies are going to operate. It gives you that freedom to kind of try to imagine what the world looks like 10 years down the road, as we all currently focus on the money printing that's happening, the inflation. It's rampant in politics right now. They're all talking about it. You've got presidential candidates showing up to Bitcoin conferences. I mean, there's a lot of things out there that make people nervous, and this is kind of giving them a way to exercise their mind and come up with a little bit of a brighter future here for what the world of finance could look like and how they can protect themselves as we move towards that future. So it's been a very exciting time, and I'm really glad to be a part of the mix.
Do you want to dive into the MSTR strategy as far as the different levers that Michael Saylor and his team have, from traditional debt, convertible debt, equity, and ATM mechanisms, and maybe as you're walking through that, maybe the right lever for each market cycle or part of a market cycle?
Yeah, absolutely. And that's one of the things that made this play so interesting to follow, is that we're really looking at what I think and what many others think is kind of the best storyline in corporate finance today, because he's taken a very non-traditional approach to this, but he's using all the traditional levers that some of these companies have. He's just utilizing them in a different way. So when you look at kind of the levers that a company like MicroStrategy has to pull on as they implement this strategy, they've really got a few main ones, right? There's the ones that everyone kind of knows about at this stage. There's traditional debt, right? Just taking a loan from a traditional lending institution. But in their case, they're taking that traditional debt and converting it into Bitcoin. They're buying a hard asset with that money. The other ones that you're going to have are things like at the market offerings, ATMs, which most companies that are publicly traded, they have. It's a way for them to raise capital basically by selling their shares into the market at whatever the current prices are, right? So they sell a share, they collect whatever the dollar value is associated with that share price. And in traditional, for most stocks, you're looking at them using that capital for operating expenses, right? Something that may not be accretive to the shareholders directly. If you're just using that capital to keep the lights on, the people that are holding the shares are getting diluted every time that you do that. And that's a problem for a lot of capital intensive organizations, right? To stick with the Bitcoin mining or the Bitcoin space, the Bitcoin mining companies have this problem because there's a lot of capital expenditures that need to be made to buy the mining equipment. And so a lot of times, because they're not good candidates for traditional financial instruments, traditional debt, they have to actually go and raise most of their capital through these ATM offerings. And that dilutes the shareholders underneath, right? And if you can't generate as much value as you're diluting, they've now lost value in their shares. So MicroStrategies is a little different, right? They're essentially looking at this going, when can we use the at the market offering in an accretive manner to our shareholders? And what that looks like to someone like Michael Saylor is they'll look at what is kind of the net asset value of our company, right? Which has largely become tied directly to their Bitcoin holdings. I mean, they have about $17 billion worth of Bitcoin on their balance sheet right now, and they've got, 4.2 billion in debt. But so he's looking at how's our stock trading relative to that asset value. And if our stock is trading higher than 1, using the ATM is accretive. Now, he's got other tools that he can use as well, so he doesn't have to use it in non-pristine conditions to do so. But when you get to these periods where, Bitcoin goes in these cycles that everyone's seen, right? The 4-year cycles where the price starts to run and then you get these lulls. Well, what we're watching right now is we're in one of those cycles where it's moving up. And that brings excitement in the market, and it brings more eyes to MicroStrategy because they're really the first player to do this at large scale. And that new capital coming into the company has pushed the share price higher and higher. So now they're trading, closer to a 3 times net asset value. Well, using an ATM when your share price is 3 times the underlying net asset value on your balance sheet, now you've got a really accretive method to purchase an asset to put on your balance sheet. So he's leveraging those inefficiencies in the market and saying, I can create continued value for my shareholders by ensuring that if I use the ATM and I'm issuing more shares, they're getting more shares, more Bitcoin per share allocated to them, right? So the shareholders win. And this is a cycle that he can do over and over and over again whenever the conditions are right. So it's a new way of thinking about how to use an ATM versus the traditional, we'll use it for an acquisition, we'll use it to fund operations, whatever they may need it for at the time. MicroStrategy is basically saying operations are covered. We have positive operating cash flow, no problem there. we're going to use that capital to buy a hard asset that provides a lifetime of potential return to our shareholders. And that's what they've been doing with the ATM. So that was a new approach to using an ATM. Then he went a step further and he looked at, well, what else is out there in the markets that there's demand for? And one of those things is the convertible debt, right? And convertible debt, for people that might not be up to speed on exactly what those instruments are, is it's a bond with an option to convert into shares at certain prices, right? The conversion price. And there's certain funds or institutions out there that can only trade convertible debt. And so he was looking and going, well, where is there demand out there in the market that will bring capital into this ecosystem? And what do they want? Right? Well, they want volatility. And so what Saylor's doing is he's offering them a product where he's going to sell these convertible bonds at 30, 40% out of the money, right? He's selling them at future prices. They'd get those shares at a price that's 30 or 40% beyond what it's trading at today. And then he's giving them this bond that they can now trade as a part of whatever they've told their investors they're going to do, which is trade convertible bonds. So now they're in the ecosystem. It's a new pool of capital and a new set of demand that comes there for you. And what Saylor's doing is he's taking the capital he raises from the convertible bonds and he's doing, you guessed it, going out, buying Bitcoin with it, putting it on the balance sheet. So it's another one of those ways to lever future value of their company, which is already higher than net asset value, and collect more money through a different instrument and bring that in, put more Bitcoin on the balance sheet. So he's been really using these levers very strategically throughout this process. And we got to keep in mind that we're only about 4 years into this with MicroStrategy, right? And the important part, I think, for him and what he really focused on early was scale. So we saw him being very aggressive throughout the last several years, making sure that their balance sheet is really directly tied to Bitcoin because it creates a separate product offering that they essentially have to bring to the market, which is volatility, right? Everybody loves volatility out here in the markets, whether you're an equities trader, whether you're a convertible bond arbitrage trader, like whatever your game is, you want volatility. That's how you create the returns. And so it's bringing all this institutional level capital to the table that's really made them the premier product for volatility in the market. And the more volatile it becomes, the more interested people are in trading it, right? So it's a very interesting dynamic that he's really laid out for the markets with a new product that is now eclipsed in enterprise value well beyond what they ever generated with what they actually core did as a business, which was the BI platform, which still performs well, generates all the cash flow that enables all of these things. So when we look at market cycles, right, which was one of the other questions you'd asked, there's different things to look for. You know, with Bitcoin going in these bull and bear markets, you start to get this expansion and contraction of the net asset value, right? The multiple to net asset value. It expands and it contracts as there's more money coming to the stock, as money's coming out of the stock. And that brings different vehicles to use. You use different levers during different times. So say a company was trading below net asset value for whatever reason. That's a tough sell to go issue equity or raise convertible debt because you're doing it below essentially the net asset value of your company. That's not really accretive, and you're going to introduce large levels of dilution early in this cycle. So what a lot of times you would see people do is they would just go raise traditional debt. If their cash flow can support the traditional debt, they'll start there. And then you wait for these cycles. If you're buying an asset like Bitcoin that you know is going to be volatile and you're expecting it to increase in value over time as the dollar debases, then you've got time where you can wait for that value to come, for that multiple to your net asset value to expand. And then you've got ways to get out of that debt if you want to, right? You could go issue a convertible bond and you could take that, refinance the debt. Or you could go use the ATM if you get a big squeeze in your share price and you could use that capital to get rid of it. But that's really your starting point if you're a cash flowing company. As that multiple expands out, you can start to look at really the two main other drivers, the convertible bonds and the ATM. Now, the ATM, you like to use sparingly and you like to use it more when that expansion has really happened. When you're getting in the 3+ multiple to net asset value, that becomes really ideal conditions to start using an ATM. But when you're kind of in that, 1.5 to 2.5, one of the best things you can do is you can sell the convertible bonds 40% out of the money, right? You can take your share price that's trading at 2 times NAV, and you can get the money at another 30 or 40% beyond that. So you're issuing less shares than what you'd have to do with an ATM today, but you're collecting that money today and buying the asset today that you think is going to appreciate. So when I look at it, I kind of see it as being your first stage is going to be your traditional debt if you're just starting out. Your second stage is going to be issuing the convertible debt. And then once that volatility really picks up in your stock and you're getting more of these wild fluctuations, when you start getting those squeeze conditions into your share price, then it's time to look at the ATM and really start utilizing that value as well.
Why is the demand so high for the convertible debt? It seems like most are oversubscribed. Like, what is going on there?
So far, I believe all are oversubscribed, right? And it really comes back to that volatility. There's the saying out there in the market, which is volatility is vitality, right? So if you're one of these funds that's locked into trading one specific thing, if you can only be a convertible bond arbitrager, and for people out there that might not be really familiar with what that means they have to buy the bonds and then they're using these hedging systems, right, to exploit inefficiencies between the bond pricing and the underlying equity pricing. So these guys, in order to make money, it's not very exciting for them to go out and get a convertible bond on a 20 vol asset that's not going to move very much. There's not a lot of opportunities for hedging in and out of your position with that. With what MicroStrategy has, when you're, a 50 to 80 vol, right, depending on what Bitcoin's doing, now you know that that stock's going to move a lot. And so these guys are looking for a place where they can deploy their capital, buy the bonds, which they're allowed to buy, and now they want it to move. They get their initial position and they'll do what's called delta hedging against that position. So you can think of it this way, right? If you buy a bond and the delta on that bond is 0.5, right, or 50, that essentially means that if you had 100 shares, the pricing of that bond is going to move as if you had 50 shares. Now, as that equity underlying moves up, that delta moves up. So now it's moving like it's 70 shares or 85 shares or 90 shares, right? And what these guys are doing is they're hedging their position. So their bond has an embedded call option in it. That's the convertible feature where you get shares at a certain price. And so what they're really doing is they're hedging with that position. And so as the price of the underlying equity goes up from where they got these bonds at, they will start taking short positions against the stock, right? They're going to hedge out some of that equity exposure. But it really fits in at a simple level to what a lot of people will understand, which is a buy low, sell high type of a strategy. And if they're expecting volatility, as that price continues to climb, they're selling short, right? They're selling as that price is going up. And then as that price comes down, they'll take that hedge off, right? And they will start to collect that profit from there. In their worst case scenario is they get to the top and they're fully hedged against the volatility of the equity, right? They might be 100% hedged if that share price goes high enough. The thing with these bonds that's really interesting is they've got levers in there where they could get their capital back if they've lost the ability to trade in and out. So say they were fully hedged, you bought it at 100, your conversion price was 130, and now the stock is trading at 200. But you fully hedged out by 145. You are 100% hedged. And now you don't see those shares coming down anytime soon. Well, you've already taken out all the equity risk. You've got the bond that's appreciating in price here, but you might get to a certain point where you may just want your capital back. So they have triggers in these bonds. It's called the 130% clause, which says if the stock's trading at 130% of the conversion price, there's a trigger in there that allows them to convert and get their shares early. So some of these bonds might have maturities that are out there in 2032, 2030, right? I mean, MicroStrategy kind of ladders out the bonds where they don't have more than one bond that would mature in any given year. They have an ability, if they've kind of lost the ability to trade and get that value out of it regularly, they could get their capital back, right? They could call for those bonds to be redeemed and they could get the shares. And now they've got their capital back, and they might be able to get into another bond offering here that allows them kind of a refill on what they want to trade at a different strike or a different convertible price as well. So they've got flexibility in these. But that volatility of the share price is really what keeps these guys coming back, because it just moves so much that they have so much opportunity to implement their own delta hedging strategies that they want these, right? These have been some of the best performing convertible bonds out there in the market. And because of that, you have no shortage of demand because there's a huge amount of capital that has to play in this space. And so it's made it very interesting where any time that MicroStrategy and Michael Saylor want to get back out to the market and issue more of these bonds, it seems that they hardly even have to pick up the phone before they're oversubscribed to get these things back out the door. We did see one of these convert already, right? The 2025s. They had some that were maturing the end of 2025, and those converted in Q2 of this year. That was kind of the first time we saw it. But the interesting thing about it was it wasn't actually the note holders that converted. So I was expecting that when they got there, we might see the note holders want to actually get out of these bonds themselves, right? Because now they triggered the 130% clause. As of the end of 2023, these things became convertible. So Q1 came, and everyone was kind of waiting for these to convert. And then the next 10Q came out, and you saw, well, no, they actually only had an immaterial amount of demand to convert these. And then what actually happened was in June, there's a no-call provision for MicroStrategy. So MicroStrategy can't just call these whenever they want. And it's usually a period of 3 years, and it might be longer when they've got longer dated bonds. But in June, that date came up, and now MicroStrategy could call these bonds for the same reason, because of the same 130% clause. And so MicroStrategy called and converted those bonds, which I thought was an interesting development out there, because sometimes you'd think, well, maybe because these were such low interest bonds, maybe they'd want to get out of them and get into a new offering of them where maybe they'd get a higher interest rate payment on them. But that wasn't the case. And MicroStrategy actually had to force the issue. So it's going to be interesting to watch with the remaining convertible bonds how that plays out, because we're entering prices now in the underlying equity that starts to allow for that flexibility for those bondholders, where they're starting to trigger some of those. Now, we're a couple years away from where MicroStrategy could call those back, but the note holders are going to start to have that optionality, and we're going to see what that looks like as we get into a bull run here as to whether or not they choose to take that, or whether they just want to hold on to that call option they've got. So it's going to be a very, very interesting period here. But I think anytime Saylor chooses to issue more convertible debt, you're going to see people knocking down his door to get to it.
Can you walk us through how the convertible debt works as far as the bondholder conversion versus the MicroStrategy conversion? And then as we kind of look out, what would a roadmap for their current debt look like as we kind of walk down this road?
Yeah. And some of that, right, some of those mechanics we kind of talked about. If you're looking at the note holders, you're really focusing on that 130% provision. Now, there's one about how the bonds are actually trading in the markets themselves. And if they get, 98% below, then it triggers a different conversion factor. But the one that most people are going to be watching is going to be that equity, right? 130% above the conversion price. So every time they put these bonds out there, if you go into the documents or the 8K and you look at what those provisions are, they'll all have a conversion price. And what you're focusing on is 130% beyond that conversion price. And there's a little bit of a delay that happens. So if they issued them in February, usually you couldn't, if the stock just took off, you couldn't convert them in the next quarter, right? You'd have to wait for the following one. There's a date where that actually becomes effective where they can do that. But typically, if you're selling some 30 or 40% out of the money, you're not expecting it to hit that quickly, although we've seen this thing move pretty fast. And what the provision does is it kind of gives you a time period out there. So say you're coming into the end of the quarter and you've got 30 days left to the end of that quarter. What you're really looking for is for 20 days of trading to close above whatever that conversion, the 130% of that conversion price, right? So if I look here, like the 2027 notes, their 130% trigger is $186.22. Which we're trading above right now, right? Last I checked, we're somewhere around the 200 range. And so we're trading above that level. So as we come into the end of the quarter, you're going to be watching, can we get 20 days of closing in a 30-day period? And if we do, that activates this clause. So then as of the next quarter, they'd be eligible to convert those notes. So that's really what you're looking for there when it comes to the note holders. There's a very similar provision in there for MicroStrategy to convert those notes, but that comes much later in the maturity of the notes. And on a lot of these, we're still pretty early. So we're still a couple of years away from a lot of those where MicroStrategy has the right to redeem. But what you're really looking at with these is, and this is my interpretation of their strategy, is that MicroStrategy is really looking for these notes to convert. I don't think that they're really looking. People always say, well, why don't they refinance them and pay them off? I don't think that's the strategy here. I think they're looking for these things to actually convert, because what they don't want to do is have to go do something either non-accretive to raise that money to pay off these bonds, or they're going to sell Bitcoin. And they don't want to sell Bitcoin because that opens up an entire different set of issues for them, things like taxes that they'll be triggering. They're just going to be going down a path that they really don't want to go. Whereas if they just allow it to convert, they don't have any of those issues. That liability just comes right off the balance sheet. And now they own this asset, Bitcoin, on their balance sheet that has no debt associated with it anymore. And the stronger the balance sheet gets, the more of this debt they can start to raise, as long as it stays within their cash flow, which is kind of the crux of the strategy. Is you have to be a positive cash flowing company so that you can support all the interest payments on this debt, right? And MicroStrategy so far is well within, people look at profitability as the metric. That's not the metric, right? What you're looking at is the cash flow that they have available to service these. And they've got about something around $65 million of free cash flow a year that they can use to support these convertible bonds. And right now they're using about 34 million of it. So they've still got plenty of cash flow out there to support this, which will allow them to do more of them if they choose to. It seems they're staying in a ratio, right? Michael Saylor said it several times, where they're looking to be kind of a 20 to 25% leverage on what they're doing with Bitcoin. And right now, I think they're right at about 25% with their $4.3 billion of convertible debt that they have out there. So we'll see if they reload here in Q4, right? They've got a slot open. They don't have any debt in 2029 right now. So, they could conceivably put more out there. But I think what they kind of watch is the expansion of the value of their Bitcoin in the treasury. And then they apply what is their target leverage to that to decide whether or not it's the right time to issue more convertible debt to keep them at that level, which keeps the volatility going in the shares or not. So I think that's what we're going to be watching for.
You've been sharing information about NASDAQ 100 inclusion. Can you walk us through kind of where MicroStrategy stands today with that? Like, how does the methodology work, and what could the capital inflows look like when they are included in the NASDAQ 100?
Yeah, this is one of the really interesting things that sets them apart from the ETFs. When the ETFs launched, a lot of people thought that was the end of the show for MicroStrategy, particularly the end of the show for having any type of a premium to net asset value. And they've turned out to be very wrong about that so far, right? We have huge amount of inflows that have gone into these ETFs. And what we haven't seen is any compression in MicroStrategy. And what makes them very different in a lot of ways is that they've got these different things that can happen with passive flows from these index funds that an ETF will never get, right? First, ETFs can't interact with the capital markets the same way that MicroStrategy can. That gives them the flexibility to do the strategy that they're doing. So you'll never accrete more value per share in an ETF. But MicroStrategy has different flexibility. So the one that's coming up now, which is one of the big ones, is the NASDAQ 100. And the NASDAQ 100, out of all of these index funds that are out there, they have a pretty straightforward methodology to what they're looking at. And for simplicity, it's basically down to your market cap, right? You just have to be a non-financial company trading on the NASDAQ. And then they start looking at the market caps and they start ranking them. And there's some nuance out there to, foreign companies that are selling shares on the NASDAQ through a depository receipt, but that doesn't apply to MicroStrategy. So we won't go through that part of the methodology. But essentially what you're looking at, if you're not in the NASDAQ 100 today, if you're a non-incumbent, you've really got to force your way in. And the way you do that is by becoming one of the top 75 companies in market cap in the NASDAQ, right? The non-financial NASDAQ. And MicroStrategy is currently sitting in that just out place, right? If I was ranking them, they're at 102 at the moment, but they've got to jump up to that 75th place. And so their market cap's been closing right around 38 billion, and that target has been right around 43 to 43.2 billion is where the 75th place company has been. So what you're watching as it goes on, and these are the posts that I've been putting out kind of every day showing where they're landing in kind of that forced rank, is we're looking for them to make that impulse move to get up above whatever that level is. I mean, we have to recognize that those other companies are changing in value regularly too. So you'd rather smash your way into the NASDAQ 100 than just get in, because there's a lot of variability out there. You don't control what's happening with these other stocks. And so currently they're sitting just out. But we've seen, trading intraday, when they did that peak the other day in the mid 220s, that would have put them in, right? Mm-hmm. So they've shown these flashes of the expansion of their market cap that would put them in that place. And it's important to note, because people, when they look at MicroStrategy, they have two classes of stock, right? They have the Class A shares, they have the Class B shares. NASDAQ's not going to include the Class B shares because they're not publicly traded, right? Those are all owned by Saylor, and somebody owns a small amount of them, but I don't know who owns the rest of them. So, but because those Class B are not publicly available, those won't count in their methodology. So that's why there's some discrepancies out there when I say they're trading at 37 or 38 billion. Other people might see that they're trading at, 42 billion. So that's really what we're looking at. And the snapshot date that's important here is November 29. That's when the NASDAQ is going to go out, and they're going to close on the 29th, and they're going to lock in place what your market cap is for all these companies. And then they're going to go through their methodology. And so they're going to look at what are the top 75, right? And those top 75, they're going to get in. But then there's some leeway for some of the incumbents. For instance, if you were in the NASDAQ 100 today, but now you would rank at 120th, you actually get to stay in. So they keep you in there, but you get 1 year of grace period for that. So then if the following year you still were outside of the 100, now you don't get in that year. So you get a 1 year grace period. So there's a couple instances where that's at play right now, but it's the reason why MicroStrategy can have a higher market cap than the 100th ranked company, which is somewhere in the 20 billions, right? 23, 24, somewhere in there. So they have a much bigger market cap than them, but those companies get to stay in. And right now, MicroStrategy wouldn't. So that's the nuance that goes with the NASDAQ 100 in terms of getting into the index. Now, what comes with getting in the index is the exciting part, right? Index funds, right? The QQQ and some of these other funds that are tied to the NASDAQ 100, the beauty of those is they're buyers at any price, right? They don't care what the multiple to net asset value. It doesn't matter. They get a weighting based on their market cap within the index, and then they get funds allocated based on their weighting. And so right now, if MicroStrategy was just to make it in, right, if they got that 75th slot, they'd be looking from probably the top 3 NASDAQ 100 funds at getting somewhere between 550 million to 600 million of funds coming in to buy up their shares, right, to put in all these other index funds that are out there. You've got to really get up to about the top 50 before you're getting $1 billion. And I think that the market cap required to get to the top 50 is right around $1 billion or $77 billion to get into that top 50. So the further up the list you climb, the more money is going to be allocated. And so NASDAQ's going to announce the new companies that are in, all the changes on December 12 or 13. I'm forgetting the date right now. It's 12 or 13. And then the money is actually going to be moved into place by the 20th. So those are kind of those key dates that you're looking for with NASDAQ to see, and I believe it's the 13th. So you're looking for these key dates that they're going to make that announcement, and you're going to start to see, do these passive flows come in? And NASDAQ's not the only index fund out there, right? You benefit in a lot of funds from having a growing market cap, and there's several funds that MicroStrategy's already in that would give them a higher weighting. So as your company grows, And as Bitcoin grows, you start to see more passive money coming into the stock, which can do some pretty crazy things to share prices, as we've seen with companies like Tesla or Rivian or any of these companies that have gotten into some of these big index funds. So NASDAQ's kind of the one that's on everyone's mind right now because that one's coming up soon. You've obviously got the gold standard, which is the S&P 500, but that's a whole different conversation out there. So that's one that we'll keep an eye on. I post on it every day just to track where I think they are based on the methodology that NASDAQ's put out. And then hopefully we'll see them enter that index and we'll see what those passive flows really do.
If another company wanted to copy the MicroStrategy playbook for putting Bitcoin on the balance sheet, like where would they start? What would that look like? Can you walk us through that a little bit?
Yeah. I mean, there's a few conditions that make it unique, that make it a really good strategy for a company, right? One of those is you've got to be profitable, right? You typically want to be at the point where maybe you're not seeing the growth that you used to see. Maybe you're kind of stagnating, right? They call these zombie companies a lot. The other thing is you want to have a strong balance sheet because the strong balance sheet is what gives you that leverage. So with zombie companies, a lot of times you'll see them being small because they lack the growth, right? The growth metrics kind of drive the stocks out there. Everyone's looking for companies to grow continuously. And when they stop, that really impacts their valuation. They don't become an exciting investment anymore, so the money flows elsewhere. And so you tend to see these being smaller companies, right? Call it below $1.5 billion market cap out there if they're a public company. And what they want to do is you want to look at what are all the levers you personally have that you could pull. The first one and the most comfortable one for a lot of these companies is look at your cash balances, right? You might be in that point where you're looking at your cash and going, what are we going to do with it? Right. One of the things we see most companies do out there in the public markets is when they start having this excess cash and they can't come up with a better way to deploy it that becomes accretive to the shareholders, right? Whether it's through acquisitions, whether it's through new product R&D, whatever it is they're working on. If they've run out of ideas there, you start seeing them issue it as dividends. Right. So there's this joke out there that once a company starts issuing dividends, they're admitting to you that they're out of ideas for this company. Right. So they're going to run. They might be a great company, but they're running out of ideas now. And that means they can't deploy all the cash they're bringing in fast enough. So a lot of these companies are in that scenario. Right. They've got a strong business. It's great, but they might have few products. But they've got strong cash flow. Now they're building these cash balances. They can't find another company that brings any enhanced value to them. They can't find a new product that they're looking to develop, and they're kind of out of options, right? The first thing you do is you look at that cash balance and go, well, what could help my shareholders, right? I've either got to give it back to them because I don't have anything to do with it, so dividends, or you look at it and go, well, what if I took that cash balance and I converted it into a hard asset that has a market, right? Bitcoin. Bitcoin's a deeply liquid market right now. But when you look at all the characteristics of Bitcoin, you go, how do I preserve the value that I've created with the business that I had that was very strong, that's performed for me for lots of years? First thing you do is you convert that cash balance, right? Cash isn't really returning anything of any real excitement these days. And you're probably not beating inflation on any of the returns you are getting on your cash. So moving cash into a hard asset like Bitcoin gives you the ability to really preserve and not debase that value that you've already created. The next thing you can look at are some of those levers that we talked about earlier, right? Depending on how your stock's trading, you might look at it and go, we're a really strong company right now. And the first thing I want to do is get to scale with this strategy, right? And to get to scale, sometimes that means you're going to take on debt because what you want is to get a meaningful amount of Bitcoin on your balance sheet. What you're really targeting here is trying to get the value of your balance sheet tied to about at least 50% Bitcoin as fast as you can. And for some of these companies that, have very few assets, but they've just had, strong cash flow, and now they don't have anything else that they're adding, that might not actually be a huge number. You have a lot of these companies in the 100 million, 200 million market cap range where they could make Bitcoin a really meaningful part of their balance sheet in very short order. So I would evaluate that first and say, can I do something that's not immediately dilutive to get this going, right? To start picking up the volatility on my stock, to do something new that messages to the market that we're pivoting, right? Messaging can be everything when it comes to the markets, and generating excitement around your company is tough to do for a lot of these guys because they've been a one-trick pony for a long time. But going and saying, we're going to take a shot here, right? We're going to leverage what we've built. We've built a strong core business, and we're going to utilize that to our advantage now. And to do that, we're going to use an emerging asset that we think is going to perform really well. So we're going to borrow money now, leveraging the strength of our cash flows, leveraging the strength of our balance sheet, where the lenders will come to them and say, yes, you can cover this debt, no problem, right? You might have a 2.5 times debt service on it, debt service coverage, which a lot of banks will look at to see whether you can float this amount of debt. Well, they would if they're that strong of a company. And so you start there by saying, what would be a meaningful Bitcoin purchase? Figure out whatever that means for your company. And then maybe you're going out and taking one of those loans at 6% or whatever the rate is at the time, and you're buying Bitcoin. And now you've introduced an asset that's going to fluctuate in value in dollar terms on your balance sheet, which increases and decreases that underlying value of your company. But what that does is it brings volatility to your shares. And that's what really enables the rest of the strategy to play out, right? You've got to get off zero and you've got to start moving forward. And then you can start looking forward to engaging the markets again and looking at those convertible debt offerings where you can either refinance out or you can do in addition to build the amount of value on your balance sheet that's tied to Bitcoin. And then as that expands, you can start looking at the ATMs and how to use that accretively. So it's one of those things where I think the most important things for these companies to do is start. And the best time to start is when Bitcoin's undervalued. And I think for most of us, when we look out, even though other people may look at Bitcoin and go, it's trading at $67,000, $68,000, like, isn't it overvalued? Well, not in the macro environment, right? If you look at everything else and you're looking at the denominator for how you're valuing everything out there, every product you buy, the houses you buy, the cars you buy, everything's denominated in dollars. And if you believe that in order to keep funding these markets, showing growth, that they're going to keep printing money, getting that out in the system, devaluing the dollar, then Bitcoin feels like the safe asset to be in, right? It almost feels like the value play that's coming up. And it sounds crazy to say that for an emerging asset class that's just over $1 trillion in total market cap, to say that maybe this is becoming the value play. But when you look globally and you see companies like Japan and all these other companies that are having issues with their national debt, where they got to print their way out of these things, it really does start to feel like the more secure play. So I think Saylor took that first step. He kind of proved out the thesis that the markets would accept this, that they will value this. And I think that we're going to see that really enabling some of these other companies to step out and say, you know what? I'm going to change my strategy as well, right? I think he's right. I don't have any better ideas. We're going to come out here and we're going to strengthen it. Now, it's not to say that other companies outside of that shouldn't be adopting Bitcoin. You should. If you're sitting on any meaningful cash balances, you have to look at how quickly that stuff's getting devalued. And if you don't have a better idea that's going to beat the expansion and the M2 monetary supply or inflation or whatever metric you like to look at, then you've got to come up with something else to do, because otherwise you're just losing value constantly, and that's losing value for your shareholders as well. So, as a fiduciary, I think that you have to explore this idea of saying, is this new asset class legitimized now in the eyes of Wall Street, in the eyes of the banks, in the eyes of the SEC? And the answers to that have been yes. And I think that allows for that flexibility where it's not a crazy idea anymore. Now it seems like you're moving, you're taking this flight to safety, you're securing the value of your company for your shareholders. And I think that's a really, really important thing to message out there today as we see all the craziness that kind of spins on around us here as we get into these political cycles. So it's a great move. And I think a lot of companies should be looking at this, certainly more than currently have.
Where can people find you online? Are there any resources that you utilize that you think are key to share? And I'll just give you the floor for any closing thoughts.
Sure. Yeah, so you can mostly find me out on X. That's where I pretty much do everything. That's kind of become my home now. So it's just at Ben Werkman, Workman with an E. It's just my name, so it's easy to find me, right? I'm not hiding out there. So you can find me on there. That's where most of my content's going to be. The thing that I've really been impressed with is how much information comes out in real time on X. You get into these communities, and as you get interested in a topic, it's amazing. The algorithms are really good. It starts to feed you really good information to your feed. So I've learned a lot out there, but I think the place that most people put as the gold standard to start, funny to say that, is actually the book, The Bitcoin Standard. I think everybody should read that book first because that really gives you the macro view of what's at play here. And I think until you build your own knowledge base, you feel like you're speculating and you don't want to feel like you're speculating. So I always encourage people to start really researching this first before you make any type of a meaningful allocation. Because if you don't have the conviction there to really hold on to a position through volatility, through turbulence in the markets, right? It's not a place where you're going to feel secure until you understand what's going on at a macro level. So I think when you go to YouTube, there's a lot of people that have talked about the Bitcoin standard. Michael Saylor has put out some amazing videos as he's dug deep into these, the Saylor series. Those are all worth a watch, right? You come away with a very good understanding. If you're a company looking to do this, I think Saylor is a great place to start because he goes into all the intricacies of the questions that they might have around the accounting treatment of Bitcoin, how to leverage it, how to use your balance sheet, right? He's been very good about just putting clear information out there for these executives who might not know where to start within the corporate environment. So those are probably the places I would suggest people start to really start to get that base understanding to give them that conviction and confidence that this is the right move to make as we move forward.
Absolutely. Well, thanks so much for the time today, and we'll have to do this again.
Absolutely. I'd love to, Tim, anytime.